My view on Bitcoin kind of remains what it always was, which was, and I coined this a while ago, is I think of it as the kind of perfect collateral layer of this new digital economy, because it's pristine collateral in the way that it can't be debased. You know, if you think of how, let's say, a treasury bond works, it's kind of weird because when everybody needs treasury bonds, the Fed creates more of them. So your collateral is actually worth less over time, which is the debasement of money idea. Now, you can't do that with Bitcoin. So if Bitcoin is your base layer of collateral, then what you get is an ability to get paid for people wanting collateral in a collateral squeeze, which is what the financial system needs at its base. But it became obvious to me that Bitcoin doesn't solve every problem. It solves certain problems really well, and others it doesn't solve as well. So that was really my evolution. And then as the space broadened out, you realized, okay, this is an incredibly deep, fast-moving space with so many applications that it doesn't make sense to be all on one blockchain. Different blockchains will specialize in different things. So that's basically my Bitcoin hypothesis.
I mean, and absolutely, and I think that's kind of an important point, and one that we often kind of are, especially the crypto narratives, being very tribal in nature, like to kind of talk past each other, and we briefly mentioned this before recording this, that it's hard to have nuanced debate on Twitter. But I think ultimately you bring up a really good point, that as someone myself who is primarily philosophically aligned with the Bitcoin narrative as bringing this kind of decentralized, sovereign, uncensorable money to the world. In order to do that in the most effective way, there needs to be trade-offs that are made that makes it impossible to have a one-size-fits-all model. So in a lot of ways, there is kind of this almost a defense mechanism that Bitcoiners have, where they're like, we can solve all the problems, but it's like, if you want to solve all the problems, then you can't solve the problem that you're really trying to solve for, which is redefining global-based money, given the trade-offs that are required.
I think that's true. Look, network effects are real, and how people drive network effects are not only growing the network but defending the network. So that's what the Bitcoin narrative is. The incredible maxi pushback is the defending of the network. We should conquer all. But the reality is, I think that, and the question I'll give back to you is, what is the money part you're trying to solve? Do we have to solve every part of money, or is that just a legacy way of looking at it? Can we break money down into certain functions and split it down? I don't know. What do you think?
Yeah, I mean, I think at its core, what Bitcoin is trying to solve for is this kind of global, predictable base money. Now, whether you incorporate sort of financial services as a part of money is a separate discussion. But I think Bitcoin at its core is supposed to provide almost this boring digital store of value that is uncensorable, that is uninflatable, that does really just one thing very well. And that is, transferring ownership in a predictable way that allows for you to go from effectively store and transfer value, and that value being high value. So effectively a large value global settlement network that requires at the base layer, I'd argue, very explicit conservative design principles, where if Bitcoin is going to be predictable in the way that it is, then it can't necessarily compete in the kind of the technological revolution that we're seeing in other public blockchains. So I view Bitcoin really as this monetary revolution that requires conservatism at the base layer, that effectively trades off the ability to compete in kind of the feature-rich world of other public blockchains.
Yeah, and I totally agree with that. The only thing I can't square in my head yet is you and I both talk about it as a base layer or pristine collateral. The issue is it's not being used as such by anybody. That's I can't get my head around, because actually what is the collateral of this current system is ETH. Now, I'm no ETH maximalist either. I'm just an observer. And I'm like, I can't square that away, because it's not like at the bottom of every DeFi protocol is the collateral of Bitcoin. It's not.
Yeah,
So
so I guess it depends on your universal set of what users look like. So I'd argue that El Salvador's adoption of Bitcoin is the type of user that Ethereum might never attract, and that's effectively because it's being used as a nation state treasury. It isn't really venture funded. It's had this kind of mystical founders myth where there isn't a single point of failure in the way that other emerging blockchains might see. I don't necessarily think that it's productive to limit usability of Bitcoin to kind of DeFi or posting it as collateral to borrow and spend. I'm from Morocco myself, which is an emerging market, and when you discuss kind of the demand for a hedge against a capricious governments, something like Bitcoin is top of mind over something like Ethereum or an exchange.
yeah, and I think the point being is they're two entirely different things. I think we
Exactly.
probably violently agree with each other, and I think that makes sense. Is it depends what kind of adoption we're looking for within it. If we're looking for nation states, corporate balance sheets, and others, then stuff like Ethereum doesn't make sense because it's not trying to be money, it's trying to do other things. But base layer of money, yes, I mean it works at that kind of sovereign state level, corporate level, a supranational entity level.
I listened to your podcast with Robert Breedlove and thought it was one of the most informative on kind of the macro take. Would love to get like what you're seeing in the markets now, as an asset allocator.
So the macro environment is, I think, why we're seeing volatility right now is the shift of narratives. Markets don't like that shift. So the narrative was the inflation shift. The inflation shift last year, I think what happened is inflation was real and inflation destroyed marginal spending and marginal investing. And I think we've seen it in meme stocks. We've seen it across the market. We've seen it in cryptocurrencies where the marginal investor got marginalized because they didn't have enough money. So I think that was one of the features of what happened. And the bond market was pricing in some more inflation, but not a great deal. However, that narrative is shifting. All the forward-looking indicators I look at look like both growth and inflation are slow much faster than the market expects. So then they're struggling to think, how do we price growth equities? How do we price other types of equities in that shifting environment? Because we're going to have a period of time where growth is slowing and inflation is going to look high, and then inflation follows because inflation lags. So I think we're at a shift. My general view, and I've held this for a while now, is that the central banks are more likely to get away with one hike, two hikes max, before they're looking at stimulative measures again. Because I don't think the economy has got traction, and we don't know what the true traction is of the economy until maybe 2 years, 3 years after the pandemic recession has followed through. That's very typical of every recession I've ever followed, is basically there is a growth slowdown that comes fast afterwards. The market panics, starts talking about recession again. Usually that doesn't happen. There's generally more stimulus. So I think it's very supportive of crypto prices overall. I think crypto's gone through that transition phase. We saw the marginal spending, investing in crypto go down. I think now all I'm doing is speaking to large institutions about investing. So I think the ongoing investment thesis continues. And I think that the central banks will be more dovish than people expect going forwards. So we should have a longer cycle with more tailwinds than most people expect right now.
Awesome. And just last question, do you think the correlations relative to other asset classes, how do you see that playing out? I know we've seen in the last few months quite high correlations with just tech equity. Would be curious to get your thoughts there on how that might evolve.
So look, everything is a risk curve. Every single part of the investable universe, and crypto is part of that risk curve. Sometimes it's correlated, sometimes it's not. When you go to a macro shift, everything gets a correlation of 1. Right. And we've seen that. So it periodically correlates and periodically decouples, depending where we are on the risk curve. It tends to be really decoupled in that mid-cycle phase where growth is okay, central bank policy is loose, crypto does its own thing. But it's when people are having to bring cash back. Let's say you're a hedge fund, you've now got a mandate to invest in crypto. You've got, your equity position blowing up. You need to reduce risk. The risk manager taps as volatility rises. VAR means you reduce your portfolio risk, so you're selling crypto, even though you don't want to. It's a function of risk markets. We won't get around that ever because everything is the same unless it's got no mark to market, which is why people like VC and people like real estate, because there's no real-time mark to market. But I think the correlation, crypto looks more like a currency in terms of its correlation, which is known as Bayesian in distribution, which means it has passing correlations that shift always. And crypto does that because it's correlated to the bond market, it's correlated to the equity market, it's correlated to something else. And it comes and goes, and sometimes zero correlation. And that's very typical of currencies. People think currencies are interest rate differentials and stuff like that. Virtually no correlation to that at all.
Very interesting. Well, thank you so much for your insight, Raoul.